Hello. Today we are going to be talking about a very interesting topic, a topic that's as such a talk of the town, particularly in the Indian markets. We all must have heard about mutual funds, SIPs, and there would be these news items like the amount of SIPs that people are putting money in every month, and that's gone up to record levels of almost about 24,500 crores, something like that, every month. So we will talk about the overall, broadly the asset management as an industry, and then talk about various products under it, functions within that, how funds are mutual funds are managed, fund administration, fund processes, and finally we'll also look at the operational aspects of funds, very popular in India and even globally as such. Let's get started with overall the asset and wealth management as an industry as such. So asset management is, as the word itself is suggesting, a very professional way of managing securities, various asset classes which come under that, investing in securities, reviewing the profit loss into it, taking corrective steps. Overall management is what we are talking about here, and that's obviously to do with the investment goals that the people who have invested in, keeping in mind those investment goals as such. When we talk about asset classes, what are we talking about? The asset classes primarily that we are talking about is equities, of course, and debt as the two single most biggest ones there, and then of course followed by other asset classes like real estate or commodities, and then there'll be certain ancillary products attached to these main products like equities and bonds. You have a derivatives to these products. You will have a foreign exchange element to it, given globalization and investments happening across countries and regions as such. So the objective is to invest in various kind of asset classes, primarily to diversify the risk as such, get the best of both the worlds, divide the investable amounts allocated to different asset classes, again keeping in mind the time horizon as well, some for short term, some for medium term, some for long term, and so on and so on. So this entire activity, the process of investing in various asset classes, keeping in mind investment objectives with the idea of diversifying the portfolio, choosing different asset classes depending on their returns and risk involved and so on. This entire thing in totality is nothing but asset and wealth management as such. However, there could be certain concepts around which are specific to certain investor class or specific to assets and so on and so on. So with that in mind, we'll begin this topic and delve into details of each of these as we go along, right? So who are these investment managers? Who are the ones who are the managing funds for people? Who are the investors, and so on and so on? So bringing to topic to a very simplified version, a fund as such, we talk about there is a pooling of funds, there is a mutual funds. Basically we are saying that there is an element of people coming together, pooling their resources, putting in their a bit of investment that they want to, and kind of collectively investing it, right? So if there is one individual, and I'm just taking a very simple example to simplify it to the lowest level, is if there's one individual who is investing, let's say 10,000 rupees, right? How much can he invest in a particular stock, or with 10,000 rupees he might just be able to buy one stock, or and that too in small quantities, and so on and so on. But if there are, let's say, 100 people and each one is pooling in, let's say, 10,000 rupees, this 10,000 has now become 10 lakhs, which means that this 10 lakh will enable the manager of that fund, the fund manager, to invest in various securities, various asset classes, and kind of reap the benefits of collective gains, or even if the one individual who had put it in one stock, if that does not perform, but collectively 10 lakh has gone into many stocks, which means there will be gains in some stocks. So you tend to kind of benefit out of collectively investing, coming together and investing funds. That's basically the idea or the rationale behind an investment fund as such. Yeah. When the investment is made, the ownership obviously remains with the investor to the extent of the money that the individual has put in. And I'm taking at this point a very simple example to simplify the concept of collective investment or investment fund as such. Now, this business of fund management or fund administration or an investment fund as such involves a lot of people. Yeah. People who come together, collectively invest the funds, kind of park their funds in a particular pool, and that pool of funds is being utilized by a fund manager who would take the decision to invest on behalf of these investors as such. Again, the fund manager is investing based on the research team providing inputs, or there are a group of people who are behind the scenes working on what asset class to invest in, when to invest, how much to invest, and so on and so on. There's a lot of study and research that goes into it. So the idea is to invest in securities, asset classes, and based on the risk profile, based on the investment horizon, the time, the asset classes, the investments are made with the objective to make better than market returns and generate these returns for the investor class. And then finally, as the investors are the owners of these funds, to the extent of the amount of investment they've made, which means whatever gains kind of come, they share those gains and so on. So that's basically the broad understanding of what an investment fund is. Let's get into more details of it. Now, who are these investors as such? Yeah. Now, investors could be anyone from an individual to a large corporate or institutions who basically want to park their pool of funds into various assets. So anyone from an individual, a retail investor like you and me, or a very high net worth individual, to institutions or funds who have money coming into them by way of, let's say, pension contributions or insurance endowments and so on. Think about this. If we, let's say, as an individual, pay our insurance premiums, or the corporations deduct certain amount out of the salaries, let's say, and park it for a future use, let's say a pension or a retirement fund, this fund that is getting accumulated every month the money that is set aside where is this money going? That needs to be invested, because money has to be invested in order to generate returns and so as to meet the future needs, for the purpose that has been the start point of such an investment as such. So, from retail investors to high net worth individuals to institutional investors, all of these people are investors in various funds, in investment funds, assets, and so on. Institutional investors, as I have just mentioned, are people or organizations as such who are managing and investing the funds that are kind of collected by way of insurance premium or pension collections, and so on and so on. So all of these pooled resources on one side coming in from various sources get invested into various asset classes, various with different time horizons, for the simple reason because the risk has to be managed in order. Because let's say, I'm taking it as an example, if the money that is collected as insurance premium, the objective of that insurance premium collection is to be able to make good any claims that may come in future, which means that there has to be money available at the time when the claims have to be settled. So with that in mind, the insurance premium that is collected will have to be invested in securities that are safe in nature and yet generate returns as such. So with the investment objective in mind, the institutional investors take a call on where to invest the funds that they have received. Institutional asset managers, again, these are collective investment vehicles, basically mutual funds in a very, very simple parlance, collective investment scheme. Again, as the word itself is suggesting, that people kind of come together, pool in their resources, and collectively as a group, these funds are invested by the asset managers. Who are these asset managers? These are people who are professionals, very qualified. They are experts in financial markets. They understand the financial markets, economies, various asset classes, and so on and so on. They are the ones who, with the help of research and trading expertise, kind of do the investments and take decisions around managing the portfolios and so on. So the institutional investors or collective investment schemes or the pension funds as such, they are a legal entity. They are basically managing various funds. Now, I'll take a very simple example just to kind of simplify this. Let's say if there is a collective investment scheme, or let's say there is an institutional fund which decides to invest in only debt securities, right? Because the money that is coming in is from insurance premiums and has to be paid eventually when the claims kind of arise. So a safe investment like debt is what the objective is, and that's how the scheme is designed to invest in only debt securities. But with debt securities, the return is comparative and relatively lower. So there could be about a question in terms of, okay, how do we increase or get a better return while not compromising on the safety aspect or capital, capital as such, allowing the capital to remain the same and not causing any loss to the capital as such. So the scheme can be modified, or there could be another scheme which says that why don't we split the entire fund and put 85% or 90% in debt, ensuring that the safety aspect is there, but 10% in, let's say, equities, where the risk is there, but the returns will also be better. So what we are trying to do here is balance out the whole thing, which means that there's a scheme which is 100% debt. Now there's another scheme which is a 90-10 kind of a thing in favor of debt, of course. So institutional investors, depending on the investment objective of the investors, the risk profile and the time horizon, come up with these different schemes, and then it's kind of left it to the investor what is it that they would like to invest in, which scheme is more suitable to their investment needs, and what is it that they'll prefer, and based on that they kind of make their investments. Basically the investment is into various asset classes, but given the sheer size of the volume and the money that is kind of pooled in, obviously they will have a larger influence on the prices or the dynamics of price movements as such when it comes to institutional investors. Collective investment schemes, as we started off, are basically mutual funds, collective investment. People come together, bring together their own small piece of investment and make it a big pool, and then this investment vehicle invests in various asset classes depending on the investment objectives that has been already pre-decided and conveyed to the investors beforehand. So collective investment schemes basically invest depending on the investment objectives in various bond or equity or commodities and so on. So they are the ones who will decide where to invest in, how to invest into, for how long, and this investment is basis a back-end team's research, understanding of the overall economy, business cycles, sectoral performances, and so on and so on. So based on that, there is a very professional way of investing into different asset classes. There could be various types within that. As I had already mentioned, it's the risk profile, it's the investment objective, it's the time horizon basis which these various schemes kind of are offered. Somebody may want to just park funds for a very short duration, ranging from 1 day to 1 month and so on. Then you can have funds which are exclusively investing only in short-term securities, very, very short-term securities like money market funds and so on. So, or liquid funds for that matter. So these are short duration or even ultra short duration kind of investment schemes where people invest in. Whereas there could be another set of investors who believes that investing in real estate could be a good idea for the next, let's say 2, 3, 5 years, and given the dynamics or the demographics of the region and so on. With that in mind, though as an individual now I believe that, let's say, I believe that the real estate prices will go up, but I don't have the required funds to be able to buy a real estate property and to invest as such or become an investor in real estate. What is the other way to do that? Well, why can't I invest in a real estate fund, which is a collective investment scheme with the objective of investing only in real estate properties or land and so on. So again, here the investment objective is to invest only in real estate, which means there is a real estate fund that can come into play. And similarly, there are hedge funds, distressed funds, and we'll talk about hedge funds particularly in far detail. Alternative funds are again funds which are basically looking to invest in alternative investments, other asset classes apart from the usual ones as such. So depending on the investment objective, time horizon and risk profile as such, these are broadly the three considerations. There are other considerations as well, but broadly these three in mind when it comes to coming up with different schemes and allowing people to invest in various schemes. So based on the investments made by various investors, or rather in a more popular way, subscribed by the investors, the units are purchased by the investors, a mutual fund issues these units to the investors, giving them an ownership in the mutual fund to the extent of the number of units that they have kind of purchased. And when I say ownership to mutual fund, I mean it's the scheme ownership that they have subscribed to the extent of the unit capital that they kind of bring in, and so on. So basically the subscriptions are collected and then investments are made into various schemes as it's been decided. Again, then the next question comes: if the investor has invested, made an entry into these schemes, what about exit? Can he exit? Can he withdraw his money? Well, again, there are different types of funds, something like an open-ended or a close-ended, and we'll talk about that in detail as we go along. But an open-ended primarily means that the investor can exit any time that they wish to, whereas a close-ended fund basically is for a fixed period and the investor has to wait till the point that the scheme is closed. So depending on the type of scheme, the investments are made, and there is one aspect of dividend as well. Now let's say there is a fund which has collectively collected let's say $1 million and has invested in various schemes. There is capital appreciation in the sense that the money has grown. Then there is also income by way of dividends. There is other corporate action that happens on those securities and they've made money. The result is that the value of those securities has gone up. The value of those units has gone up. If I had put in, let's say, $10,000 in this fund, and if each unit is, let's say, $10, then my $10,000 is basically 1,000 units that I purchase at $10. But by virtue of the capital appreciation in the fund, the securities, the prices of the securities going up, the value of this unit has now from $10 become, let's say, $15, which means my 1,000 units, which were originally worth $10,000, are now $15,000 basically. The collective investment scheme may decide to distribute some of this gain in the form of dividend, and chooses to sell certain securities, generate cash out of it, and distribute it amongst all the investors. So that's again an element of dividend distribution, where a part gain is distributed while the scheme remains intact, the investments are there. Only a part of it is actually, a part of the gains as such is divided amongst the investor. So you can have one more variance or various schemes out of it to say that there could be a dividend distribution element to the scheme as well. So kind of taking it forward, if a scheme is is ensuring that there is no dividend distribution or there is no income distribution aspect into it, but the entire gain is going to get reflected in the value of your units or the value of the securities that are being invested into. And basically it's a growth fund, which means the scheme that started off with $10 with by virtue of investments and the capital appreciation, the $10 is now $15, $18, $20, and so on and so on. So the entire gain is reflected in the value of the units, which is nothing but a growth. Income, as I mentioned, some part of the income is distributed. Again, at the start I had mentioned about the investment objective. Why is an individual investing in a particular scheme? Now, if there is an individual who is, let's say, investing with the objective of getting periodical returns, while also looking at gains, but needs or expects a part distribution of income coming in at a regular point, then you can have a scheme like an income fund where there is a distribution happening periodically, and it could be pre-decided or it could be agreed upon based on the mandate and so on. And trying to get the best of both the worlds between the growth and the income, you could have a balanced scheme as well. So it's by the investment objective is how a scheme is kind of offered, and investors based on their preference would make an investment in such a scheme. On the other hand, by virtue of the structure as such, it's basically an open-ended and a close-ended scheme. I did mention about this. Open-ended or a close-ended is basically to do with the exit that an investor gets out of a scheme. A close-ended is for a fixed period, and an open-ended scheme, it's basically anytime exit is possible. Yeah, and when I say interval, it's basically periodic. Certain periods are decided where close-ended or the exit can be agreed upon. Let's try and understand open-ended and close-ended fund in detail. Yeah. So what are open-ended funds? Now, open-ended fund does not have any restrictions in terms of the number of units that are being issued, or there's no fixed number of capital, a fixed amount of capital that they want to operate with. In the sense, there is a fund that starts off with an X amount of unit capital, let's say, and additional people can keep adding, keep investing in that fund. At the same time, people can exit as well. So basically, an open-ended fund is anytime entry, anytime exit. A majority of the mutual funds today are open-ended funds. It's basically dependent on the demand and supply as such. If the demand is high enough, the fund will continue to issue new units, because simply people want to invest and people want to buy more units of that particular scheme as such. So of course, people who are who have invested at the start will be investing at the face value of the unit or the unit price as such. But someone who wishes to purchase these units at a later date will obviously purchase at the net asset value, and we'll talk about net asset value as we go along, which is the NAV or the NAV as it is very popularly called. So open-ended scheme basically is anytime entry, anytime exit. On the other hand, a close-ended fund is a fund that starts off at a particular time with a particular time horizon, and no entry or no exit is allowed in between. Yeah. So the idea is the issuance of these units are done by way of a public offering as such, and people who invest in these funds are supposed to technically, theoretically, supposed to stay till the end of the period that's been decided. However, and as I said, this is theoretically possible. If an investor wishes to exit, it cannot go back to the fund and ask for money and sell the units back to the fund as such, but the fund lists these units on a particular exchange, which means that the mutual fund or the fund creates a marketplace where these units can be traded, allowing the investor who wants to exit to sell it to any other investor who wishes to buy. So in a close-ended fund, an investor can exit the fund before the stipulated period by way of selling the units to any other investor at a price which is the listed price based on the demand, supply and the NAV again, because the value of that particular unit keeps changing based on the market value of the investments and the appreciation as such. So that's basically a close-ended fund which is classified or understood by means of the entry and exit being restricted as such for close-ended funds. Now, what are alternative investments? Alternative investments are sophisticated investments which carry different risks to different investments such as shares, properties and so on. And let me make you understand this by way of giving examples here. So you have funds like real estate funds. We talked about real estate funds a while back, explaining if an individual investor or any other investor for that matter wishes to invest in the real estate sector or property market for that matter, the real estate fund could be a good way to participate in the real estate sector as such. On the other hand, you could have hedge funds, private equity, private debt and fund of funds as well. So hedge funds basically, they operate in the markets. They are just like any other funds, except for the fact that they do not use traditional tools, but they use strategies which are more aggressive in nature, riskier in nature, with the objective of generating higher returns than typically any other fund would generate. So they use techniques which are not traditional, could be short selling, could be derivative instruments, could be leveraging and so on, with the idea of generating better than market and better than comparatively better than return, better than other funds returns that are better than them. Yeah. Similarly, there could be private equity funds. So it's basically where is the investment made that defines and classifies the fund here. So if the fund is focusing only on buying shares which are not listed or publicly available, right? The investment objective is to catch early and invest in companies that have a good prospect or have not really gone public at this point, right? The idea is to create a fund where individuals can come together up to about 100, they contribute the fund and then they kind of invest in companies which show a lot of good potential and not really listed at that point in time. So the idea is to trade in non-public listed companies with the idea of taking a substantial stake or making a substantial investment in the company. On the other side, of course, it's the promoters or the founders or strategic investors who probably would want to sell their stake and so on. The idea is to lock in the fund or invest rather for a longer term time horizon as such, and that's basically what a private equity investment is all about. Yeah, hedge funds we've already talked about. It's very aggressively managed fund using techniques like derivatives or leverage or short selling, with the idea of generating returns that are better than any other conventional mutual fund or collective investment scheme would be able to. It could be, trading strategies, long short, or there could be trading in volatility or seeking arbitrage opportunities and cashing on that and so on. So various techniques with the idea of an aggressive approach towards generating better returns. The investors and fund managers now, the differentiation, and it's imperative here and pertinent here to talk about the difference between the role of an investor vis-a-vis a fund manager. So an investor here is though investing their funds, but they do not really take any investment decisions. We've already established it's basically a collective investment scheme. Every party kind of comes together, pooling in their resources and kind of giving it to the fund manager for them to manage the funds better. So on one side you have these investors who are only investors with the objective of generating returns, but they may or may not possess the capability or the expertise to invest in the market, which is why they have pooled in their resources, and the fund manager is the one who possesses this expertise and is investing on behalf of all the investors as such. So retail investors, high net worth investors, institutional investors, we've already talked about the various classes of investors that are investing in funds and collective investment schemes as such. But the investment manager is the one who is the professional person who is managing these financial assets, taking decisions of where to invest, when to trade, when to exit, keeps reviewing the portfolio, decides on which asset class to invest in, how much to invest in, what should be the percentage allocation, for what time period, and so on and so on. So it's the investment manager or the fund manager who is the one who has the expertise, understands the financial markets, understands the asset class, and he's the one who is taking decisions in terms of the entire investment process as such. So when it comes to the structure of a typical hedge fund, you will have these investors on one side, and again could be given the nature of the fund, and we've already talked about it, it's an aggressive fund, restricted to a certain class of people because the ticket size is very high. These are people who come in maybe ultra high net worth or net worth individuals as well, and they're the ones who are pooling in their resources and giving it to the management company, the hedge fund management company, which will then take a decision in terms of where to invest in, how to invest in, what sort of techniques to use to maximize the returns, leverage decisions, derivative products, and so on and so on. So it's basically the hedge fund management company that decides on where to invest, how to invest, and so on and so on. So from a structure and the relationship perspective, it's the fund manager which on one side has is dealing with the investor class and the money that has been received as pooled resources, and based on the research team and the collective expertise that is available in the fund, in terms of the people involved, takes a decision in terms of where to invest in, how much to invest in, so on. And then comes the part of actual execution of these trades. Remember, the fund manager is a person who is taking the decision on where to invest and what asset class to invest in. But the process of actual buying and selling of securities will have to be done through a broker, and in this case a prime broker, and we'll talk about what a prime broker is in detail as we go along. So the decision is taken by the fund manager, the execution is done by the prime broker, and then there is entire process of right from trade execution, trade booking, trade capture, and reconciling the various books, and then following the entire process of very day-to-day basis valuation of the portfolio, taking decisions in terms of whether to exit the security or not, or retain or add, and so on. So it's constant reviewing of the portfolio. Then there are because there are people who on the other side who are investors who want to exit or make fresh entry or make additional investments. So the investors, there's a service element to it. So there's an investor service element to it, which means it's a day-to-day dealing with the investors in terms of their requests for exit or fresh entry or additional entry and additional investments and so on. Then of course it's the tax, the accounting aspect of it, the tax compliance part of it, and maintaining these entire records as such, which is done through the registrar and transfer agents as such. So if you look at the entire investment management industry, and we'll talk about these in detail, you would have a fund which has other support entities participating and helping in the entire management and governance of the hedge fund. So it's the registrar and transfer agents, it's the custodians, it's the investment advisors, prime brokers, and prime brokers and executing brokers are also there. So there's a difference between who's a prime broker and an executing broker. So let's talk about those in detail. Now let's talk about fund administration as such. So what is fund administration? The entire operations aspect of the fund. On one side you have the fund manager who has the entire pooled resources, the investable funds available, and is now looking at investing these funds into securities. Who are the parties that are involved in this, and what is this entire process, what are the operations involved? Let's talk about that. So fund administration is a set of activities carried out in support of the process, right? In support of the process of running this entire collective investment scheme. So a fund manager, now let's just break this into a few pieces so as to understand this better. So the fund manager is supposed to and is required to invest in the securities. So he is basically taking a trading decision, what to buy, when to buy, how to buy, how to sell, all of those aspects, right? The other aspect is the post-trading element of it. Once the trade is executed, there is this entire process of settlement of securities, dealing with various agencies, managing the post-trading activities and so on. Who does that? That's someone called as the custodian, right? And we'll talk about custodians as we go along. So the entire process of trades, trade settlements, the entire process around reviewing the securities and settling the securities as per the fund managers' decisions based on the investments and the research team's advice will be carried out by the custodian. And on the other hand, there is this fund administration, which means, so you have the investor class who have given their funds. So there is the element of these units that have been issued to them, and these units are also being repurchased, withdrawn, additional purchases are made, additional investments are made. So that management, that administration is one aspect of it. The second aspect of it is the trade side of it, which means these funds are now going to get invested into different asset classes, which means the trading and the settlement aspect of it. All of this constitutes fund administration as such, right? So let's look at the roles as such. Any typical fund administration will have three broad roles as such: the front office, the middle office, and the back office. The front office essentially is only about the trading aspect of it, the trade execution aspect of it. It starts off with what to buy. So here's where the research team comes into play. Based on their research, based on their models, a decision is arrived at that, okay, the investment has to be made in a security. The execution of that trade is something that the front office will then carry out, which means the traders will talk to, liaise with the broking community, the prime brokers, the executing brokers, and get the execution done, which means get the trade done. Once the trade is done, the trade booking, which means recording the trade details, because the trade is being executed at the marketplace. The first step within the organization is about receiving the confirmation of the trade details as such and recording it in the internal system. So that's where the trade booking and the trade support starts. And moment a trade is executed, risk management begins, because if a trade is executed and the price of the asset class keeps changing, it's ever changing, right? So moment a trade is executed, the risk has to be ascertained, the risk has to be understood, and the risk has to be managed, because the price is moving, which means the price that the fund manager bought at, and the next minute the price has changed. It's either a profit or a loss, and so on. And given the sheer volume, we are talking about millions here. So risk management has to start immediately as soon as the trade is executed. And with that also comes compliance. Regulatory authorities of capital markets, funds, want to ensure that the investors' interests are always safeguarded, which means they monitor the funds, how are they operating, what are they investing in. There is a reporting, there is a compliance to various regulatory policies. All of that is something that the middle office will do. And finally, once the trade is booked and the risk management does, the entire post-trading, which is basically the clearing and settlement activities, have to be done by the fund administration, and recording, as in accounting those securities and managing the books and accounts for those. That's something that the back office will do. So the trade support team will do the trade matching, the confirmations will be done. So let me dwell a little deeper into this entire trade life cycle as such. So once a trade is executed, it has to be matched in terms of the details. And why is it required to be matched? Because there could be some discrepancies relating to price, or there could be certain errors at any end as such. So just so that if there are any errors and that could be caught at the start, a matching process is done, and once the trade details are matched, a confirmation is exchanged, giving a go ahead that the details are matching and now we are ready to settle this trade. Based on this, the settlements are kind of done, and again settlements will depend on the asset class, whether it is an exchange traded one, whether it is an over the counter, depending on various jurisdictions, the settlement systems of that particular country or region, and so on. At the same time, we've already talked about that the risk management has to be in place, which means that there is a real-time calculation of the price of the portfolio, the change in the value of those securities, and consequently the change in the NAV as such. Again, certain securities also have the element of collaterals as well, so the collateral management has to be done. So if, and I'll just give a small example to substantiate this point, that if there is a security that is based on certain collaterals, we have to also look at the price of the collateral, because the collateral price is also changing. So if, let us say, and I'll just make up this example, that if I have borrowed let's say $100 based on an asset which I possess, let's say gold, which is worth $120, let's say, and I have taken $100 against this $120 and purchased certain securities at $100. I have now two securities to constantly value and look at their values, because it's not just the security that I've bought, the price is changing, but it's also the value of the collateral that's changing. So there is a cash and collateral management that also needs to be done alongside. Attributions and contributions refers to how is the fund attributed to what asset class, what percentages, how are the funds allocated. All of this is a part, and there's a constant monitoring of whether the entire attribution is as per the objectives that have been already decided. Then there are corporate actions, and corporate actions is a separate topic altogether. We'll deal with that in far more detail. Constantly pricing the securities, valuing the securities so as to ascertain the value of the portfolio and the value of the NAV, and calculating the NAV as well. And finally the reporting aspect of it, which is basically the P&L that is again real time, almost real time as such, and reporting this performances or the element of risk that is being calculated, and the measures taken to manage and mitigate that particular risk. And this is a part of the overall reporting, which also would be a part of the regulatory reporting as such. So the back office does this entire investor allocation, investor onboarding, which means the units again, and typically for an open-ended scheme you will have an entry and exit happening practically every day. Some investors want to buy, some investors want to exit, some investors want to switch, and so on and so on. So you'll have an entire team of personnel in the back office who would want to work on the investor services, including the AML, KYC, and the reference data management, basically RDM, which is basically managing the database of the investors. The reference data is nothing but a static data pertaining to the investors, the records as such of their ownership, their details, their personal details, and so on. So that's something that the back office will diligently do it. Net asset value represents the net value of all the assets that have been invested into, the current value of those assets, and minus of course the liabilities as such. So the NAV basically is the total value of the current assets as such minus the current liabilities. Example, if you have an investment made of a fund which is, let's say, 100 million, and securities worth 100 million are bought, the price of these securities keeps changing, will change. So some securities the price will go up, some will go down. As a result of this, the next day, assuming I'm talking about the day-to-day basis, the next day the net value of these securities turns out to be 101 million. We started off with 100 million, next day it's 101 million. So basically, how is this 101 million calculated? It's basically the current value of all of those securities that have been bought minus any liabilities. And what are these liabilities? These are basically expenses towards trades, executions, fees, and so on. But what you arrive at is the net value of all the assets that are in the fund today. That's the formula. It's the total assets, basically assets minus liability, and divided by the number of outstanding shares or units, right? So if, and I'll just quantify this, make an example here. If let us say we were to say that there is a fund which is 100 million, and that is a result of, let's say, 10 million units issued for 10 each, then you will have the value changing and coming to now 101 million. This 101 million divided by, so it's 101 million minus any of the fees and expenses as such, but the current value of those securities divided by the total units outstanding as on that day will have to be taken as a denominator, and that's how you calculate the NAV. We've already talked about assets and liabilities. I'll spend more time on what goes into assets as such. Apart from the current value, you could also have certain income that gets generated. So example, if I were to buy, let's say, shares of Tesla or shares of Apple, let's say, and post the purchase, if the company declares a dividend, let's say $1 per share, that's an additional income over and above the market price of the shares that I possess, which means that's an additional income which has to be taken into consideration while calculating the NAV. On the other hand, there could be expenses, the fund management, the staff, the salaries, and the fees, office, and payment to the marketing guys, or the management expenses. All of this is cost which has to be obviously deducted before we arrive at a net number that is available for the investors as NAV. So here's an example. We've already talked about all the elements of it, but I've given a numerical example here, which is to say the value of securities taken into consideration, then the cash that is available. All funds may not be invested all at one go. So if the fund was 100 million, maybe 75 million is invested, some is kept. So it's the value of the securities, the cash, and the cash equivalents that is available. Then the accrued income, which is by way of dividends and so on. Any liabilities, short or long term as such, have to be taken into consideration. Expenses, any other expenses, could be even day-to-day expenses as well. And all of those put together, assets minus liabilities, and then divided by the outstanding number of shares, and that's where you get your net asset value, which is your NAV. Yeah. So these are the functions of the fund administrations. They're supposed to be doing the trade settlements, they are supposed to do investor services, they are required to calculate NAV on a daily basis, then the NAV needs to be published for investors and public as such. Then there is preparation of reports, annual reports, semi-annual reports. Financial books and records need to be managed, and the day-to-day administration of the fund in terms of dealing with vendors, staff, salaries, expenses, all of these need to be done, and that's basically the entire gamut of activities that fund administrators do. And furthermore, these could be reporting assets. We've already spoken about the regulatory requirements, risk reportings as such, and so on. So these are broadly the functions that fund administrators carry out on a day-to-day basis, including the P&L, the accounting functions, and so on, and the regulatory reporting, which is also not just the regulatory reporting post the fund is into being into play, but before that, it starts off with even the prospectus and getting new investors to kind of come on board and invest in the schemes. Then there are various regulatory requirements which could be CFTC or FINRA. Complying to the policies and the regulatory requirements is also a task of the fund administrators as such. Now let's look at some of the investor services which are very important. Basically, investor services refers to the record keeping side of it, and because we are talking about collective investment schemes where you have the set of investors who have subscribed to the units, subscribed to the fund as such. So there is a whole set of things in terms of investor services that are required to be.
सर वापस कंटिन्यू करना है?
हाँ, मैं वापस कर रहा हूँ, डोंट वरी, शुरुआत से ही कर रहा हूँ मैं, ठीक है? ओके. Now let's look at some of the investor services that are extremely essential as far as providing record keeping and other administrative services are concerned. Basically, investor services refers to the services that are done for the subscription holders, the subscribers as such. These could be third party administrators or a transfer agent or any other financial intermediary. What is important is to understand the role played by these investor services, and that includes the reporting, which is the most important part. The money that has been pooled and by these investors is getting investors. First and foremost is about the investor reporting, including the portfolio performance or the analytics around that and so on. Then there is a constant churn of investors. There are new investors who are subscribing to the units. There are some investors who are exiting. There are part withdrawals. There's so many activities that are going on. So managing the investor contacts, the records, the maintenance of their holdings, and day-to-day valuations, all of this is also an extremely important task, which is a daily activity, in fact, and needs to be done. And apart from these, there are many other ones like calculations around the capital calls or distributions, any dividend distributions, and so on. Taxation related matters are to be adhered to. AML KYC is a very important aspect of the financial services business. So that's something that the investor services will always have to monitor and comply with as per the regulatory requirements and so on. Apart from this, the prime brokers is another activity as such, and it's very important to understand prime brokers as such. Prime brokers basically are not just offering the broking services, but they offer over and above services like custodial services or lending, securities lending, and so on. What is the difference between a broker and a prime broker? So, a prime brokerage basically, by the very function or the nature of the business, do not just do broking as a business, but go beyond that and also do the post-trading activities. I think very simplistically speaking, it is the equivalent of a broker for an individual. Now, a broker for an individual will not just do the execution, but also the settlement aspect of it, right? Or collection of securities or depositing in the depository account and so on. The same thing, if it was an institution, there will be a broker who will only do execution services. The rest of those will be done by a custodian as such. But here, in the case of prime broker, the prime broker does all of these activities and provides some sort of a one-stop shop for the investing company as such. Yeah. So, the services that prime brokers offer start from executing the trade, that is broking and trading on the platform, and then also the clearing, settlement of those securities, the cash management, and going even up to securities lending business if that's what is offered by the prime broker as such. So, prime brokerage is a bundled services concept as such, where a broker is providing all of these services under one roof. Custodians, we've just made a mention of it basically, but custodian, and we'll talk about it in far more detail as we go along, but custodian here is an organization that provides post-trading activities. Post the trade is done, all the other activities relating to clearing, settlement, corporate actions, many other services, funding and handling other aspects of the business, all of these services are handled by the custodians. They are the post-trading securities and settlements agents as such. Depository, on the other hand, is a central safekeeping of securities basically. They hold the securities in a dematerialized or an immobilized form, right? So, depository is a place where the securities are held, and examples are Euroclear, Clearstream, DTCC, and many other. So, a depository holds the securities, and a custodian does the post-trading clearing and settlement activities for its institutional clients. So, what happens is the custodian acts as an agent on behalf of the institution. Once the trade is done, the custodian takes over all of those trades and handles the post-trading activities, liaising with the depositories, liaising with the banking infrastructure or banks or clearing banks, and conducts the entire set of activity of clearing and settlement as such. Right? Now, I have mentioned the word about holding securities in immobilized form or dematerialized form. Now, let us try and understand this difference. Immobilized form basically means all of the securities that was available in paper form is kept physically in one location, and there is no movement of that paper certificate. Now, most of the economies are following the dematerialized form, which means that the securities that were originally in physical paper form are dematerialized or destroyed, and a book entry which represents the ownership is maintained. So you have a register which says that XYZ is holding X securities with a quantity mentioned there. There is no physical paper, there is no certificate here. Since the certificate is destroyed, it's the dematerialized form, demat as it is very popularly called. And these securities, whether in immobilized form or in dematerialized form, as a book entry, are maintained by the depositories as an electronic record on behalf of the clients. A custodian handles the post-trading activity. So it's an institution which is basically giving services to all the institutions to manage all the post-trading activities. So the institution has to merely do a trade through the brokers, and the trade is then passed on to the custodians, and the custodian will do the entire set of activities of liaising with the exchanges, the clearing houses, the depositories, the banks, and do the entire trade clearing and settlement activities. Yeah. So basically, a custodian is giving safe custody or warehousing of the securities, right? Maintains a record of the securities, the holdings basically. Also handles corporate action. So if an institution is holding 100,000 shares of, let's say, Tesla or Apple for that matter, if there is a corporate action, if there is a dividend, or if there is a rights or a bonus, all of those activities will be handled by the custodian. Then the clients for these custodians. So a custodian basically is offering these services to any and every institutional clients who wishes to outsource their post-trading clearing and settlement activities to and get them done by an external party. So it could be funds, it could be retirement plans, it could be insurance companies, it could be corporations, and even large private banking clients as well. So the idea is to outsource these activities to a third party called as a custodian, and they will do the entire post-trading activity, record keeping and position keeping and so on. Basically, custodians, and as the word itself is suggesting, they are responsible for the possession and the control of their clients' assets, right? Which means that the asset could be in immobilized form or dematerialized form. If it's dematerialized form, then it's obviously a electronic entry as such, and basically the control in terms of where is the security, where is the ownership. It could be any other foreign location, any other geographical location as well. Now a custodian can have some variances here. A sub-custodian or a local custodian, right? Now most organizations, because of their investment interest across geographies, would like to have a custodian which also has offices and can offer services across geographies. So if, and I'm just making it up, if there is a organization like HSBC or JP Morgan, they would have custodial services offered in major financial centers, which helps them to offer these services to any investment manager or investment house or any funds or hedge funds for that matter. That means they just have to deal with one custodian for all the other markets, for major markets as such. So they have one custodian for across geographies. That's your global. But if they are not present, let's say, in one of the economies by virtue of their strategy or plan, then the organization will have to appoint a custodian locally in that particular economy, which is nothing but a sub-custodian or a local custodian. So while there is a global custodian, so I'll just give you an example, and I'm just making it up. If there is a custodian, global custodian like HSBC, but HSBC is not present, let's say, in one of the countries, then in that local country a local custodian will be appointed, and that custodian will be offering custodial services in that location, in that country, and will be termed as a local custodian or a sub-custodian. Region is slightly bigger than just the specific country, which means if let's say again, if I have HSBC for the entire APAC region, which means HSBC will provide custodial services across the Asia Pacific region, which makes them a regional custodian for the client. On the other hand, depositories are merely maintaining the electronic records of the securities, right? So it's basically holding these securities, and we've talked about it earlier, that the securities are either immobilized or dematerialized. If you're immobilizing the securities, which means the securities are available in physical form but do not move and are immobilized and are maintained and kept in one particular location. In the case of a dematerialization, the securities are not there in physical form, are destroyed basically, and an electronic record is kept which proves or which states the ownership of those securities. Example, if you have a gold depository, gold cannot be destroyed, should not be destroyed rather, right? So gold has to be immobilized. So gold is kept in one particular location, immobilized, and if there are sales and purchases, buy and sell happening, then it's the record keeping that changes, that maintains the new buyer's account or credits the account to that extent. So the records change as per the buying and selling, but the gold remains in one particular location, which is called as immobilization. On the other hand, you have securities which are in paper form, which represent the ownership of shares or bonds in a particular company or a corporation. Then these securities need not be in physical form because it's a mere paper, and these are dematerialized or destroyed, and a record is kept in terms of who holds how many securities. So the depositories basically maintain the records of the securities held by the investors. The idea is to facilitate and make the transfer easy. Earlier, when it used to be physical certificate, it would be very difficult because the transferor would have to sign the transfer deed, then give it to the transferee or the buyer, who would again put his own signature, and these would then will have to be sent to the registrar and transfer agents or the depositories, and then they would change the ownership in their records and reflect the new ownership, which obviously took time. But now the idea is it's a mere book entry, which means the physical paper, the physical form is missing, right? The idea is if somebody is selling the securities, and so A is selling it to B, it's the record in the depository that has to change from A's name to B's name, which means seller A, buyer B, and the record is changed now, which basically is change of ownership. Now again, depositories, there are depositories which are central securities depository, which basically means that they not just handle the local securities but also international securities basically. So there are securities depositories which are at a national level and ones which are at an international level, and here are some of the examples that have been given. Now what is a clearinghouse? And this is very important. A clearinghouse basically handles the post-trading clearing and settlement. So an exchange provides a platform for trading, which is where the buyers and sellers come together and trade. Once the trade is done, the post-trading, the clearing and settlement is done by the clearinghouse as such. Now, so a clearinghouse gives clearing and settlement services, be it securities, be it commodities or derivative transactions and so on. What is important here is the mode or the method in which this is done, right? So when a clearinghouse assumes the responsibility of clearing those securities, it will ensure that the seller is delivering the securities to the clearinghouse and the buyer is paying for those securities, and they are doing the other way around. They're paying the money that is come from the buyer to the seller, and the securities that have come in from the seller, they're giving it to the buyer. So they are basically doing a delivery versus payment mechanism. The clearinghouse guarantees trade settlement in the sense that a clearing and settlement agent, clearinghouse for that matter, acts as a central counterparty, which means there is a buyer and there is a seller. The central counterparty means the CCP will act as a seller to the buyer and buyer to the seller. So they step in between, and for the buyer acts as a seller and for the seller acts as a buyer, which means that even if one leg fails, the other party is assured that the trade will settle. So this is the concept of central counterparty, which is very important to ensure that the settlement is guaranteed. Now these are some of the examples of securities corporations basically. So the National Securities Clearing Corporation, the Fixed Income Clearing Corporation, and the ones in Europe and so on. Now a registrar and transfer agent. Now basically a registrar and transfer agent is the agent of the company. Now the company has issued the shares and there are thousands, lakhs and millions of shareholders. The R&T agent, the registrar and transfer agent, maintains a record of all the investors, all the shareholders basically. And since there is a day-to-day activity of buying, selling happening on the exchanges, these records need to be updated every single day, right? The company needs to know who are the owners of the company, who are the shareholders, and the registrar and transfer agents provide this information to the company. They are the ones who maintain a record of all the investors and keep updating it on a daily basis. So these are basically the parties which hold a very prominent place and play a very integral part in the entire trading, clearing and settlement process in any economy for that matter.
Found this session valuable? Hit the like button, subscribe to our channel and tell us in the comments below what topic we should dive into next.